And now let's take a look at how the markets have performed this week.
The stock markets remained range-bound this week, with the Sensex closing at 15,689 and the Nifty at 4,680. The shares of NHPC, which made its IPO in August, listed on Tuesday at a modest premium. The shares opened at 42 rupees on listing day but closed lower at 36.7, barely above the issue price of 36. Other recent IPOs such as Adani Power and Raj Oil also did not deliver very large listing gains. After lying low in recent weeks, international gold prices moved to a 6-month high of $995 per ounce this week. A weaker US dollar and worries about the stock markets falling helped gold prices. In domestic markets, gold hit a 7-month high of 15,935 rupees per 10 grams. In India, prices were helped by festive demand as well.
Most of us wish we could save more money, but how do we do it and how do we get started? Here is a brand new segment where our expert will help you choose the right instrument. For those of you looking for a better balance between risk and reward, it may be advisable to take the mutual fund route. To understand mutual funds better, we are now joined by Aarti Krishnan, who heads the research bureau at BusinessLine. Welcome, Aarti. It's a pleasure to have you in our studios. Let me start with the very basic question. What are mutual funds?
Mutual funds are basically vehicles that pool together investments from several individuals and then invest that in a portfolio of stocks, bonds, money market instruments, and so on. You may ask me, what is the benefit of having a mutual fund? First thing is because it pools the savings of so many people together, it results in better bargaining power for the fund. The fund gets to transact with lower transaction costs. You can have the benefit of professional managers whom you may not be able to hire on your own.
There you go. So, Aarti, when you say it's a better investment vehicle, obviously you're comparing it to the traditional ways of saving money, which is usually people consider putting their money in savings accounts, fixed deposit, or even buying gold. Yeah. So let's do a comparison between gold, for example. A whole lot of people do that in Chennai, in Tamil Nadu as well. Tell us, what are the returns, for example, on gold investments versus some of the mutual funds?
If you take a 10-year period, you will find that gold has returned about 6% on an annualized basis. That's not much better than your savings bank account, whereas a good equity mutual fund would have given you a 25% annualized return over the same period. Typically with gold, what happens is just like stocks, gold prices do fluctuate. So you need to invest at the right time and get out at the right time, even with gold investments.
Great. Tell us, give us a size of the market. How many mutual funds do we have now in the country?
We have about 35 fund houses offering 250 different equity products. There are also a whole host of debt products, gilt funds, and so on, which are mainly invested in by institutional investors.
Great. And let's compare that to the stocks. I know we have 2 different exchanges in the country.
Yeah.
So approximately how many stocks would there be?
In the National Stock Exchange, there are about 1,500 stocks which are listed and traded. In the Bombay Stock Exchange, there are more than 5,000 stocks.
So, well, there you go. So 5,000 and 1,500 stocks, that's a whole lot for any human to track. But if you're considering 250 mutual funds, the market's much smaller there.
Exactly.
With some professional help, you can probably choose what suits your needs.
Right.
Tell us, who should buy mutual funds?
Basically, I would say 3 conditions need to exist for a person to prefer mutual funds over direct investments. The first thing is he should be willing to take a little risk, because all mutual funds do take on market risk. You'll read that legend in offer documents too. Mutual funds investments are subject to market risk. So when the prices of securities in which the fund invests move up and down, the fund's NAV also will move up and down. So if you're looking for capital protection, do not go for mutual funds. FDs are a better option. The other thing is that fixed deposits are also, with banks especially, are subject to insurance, which mutual funds do not offer. The second category of investors who should go for mutual funds is people who do not have time to monitor their portfolio regularly. So they'd like to have a professional manager overseeing their portfolio. The third thing is liquidity. Mutual funds are one of the most liquid financial instruments available to the investor, and so you can encash on your units within 48 hours of your submitting a request for redemption.
Let's spend a minute there. So I own a fixed deposit in a bank and I want to break that, I want to take my money out. Usually there'll be a penalty involved.
Right.
With mutual funds, help me understand. How do I take my money back? You said I could get it back within 48 hours.
That's right.
What are the steps? How does that work?
Typically, when you apply for a mutual fund, in the application form, you will have a portion called the redemption request. So anytime you want to redeem your fund, you can just fill in that request and hand it over to the registrar or the fund office itself. Within 48 hours, the check will be given to you. One thing we have to note is that some funds charge an exit load, which is a charge for early redemption. Basically, if you pull out your money from an equity fund within 1 year of the investments, you may be charged 1% of the NAV as the exit load. They typically do that to encourage long-term investments in mutual funds, especially equity funds are supposed to be a 3-year vehicle. So if you redeem very early, it is not in your interest too, which is why the exit load is typically charged.
Now, tell us also about the entry loads. You said it's, before the conversation on screen, you were telling me that it's, the government has disallowed.
That's right. With effect from August 1st this year, the Securities Market Regulator, SEBI, has made it mandatory for funds to waive the entry loads that they were charging to investors. Basically, earlier when you used to invest in equity funds, funds used to take away 2.5% of your investment towards an entry charge, which was paid as commission. But from August 1st, SEBI has disallowed this practice. So funds have to offer their units to you at the prevailing NAV.
So there is no such thing as riskless mutual funds, by the way.
Yeah, there's no free lunch actually. The returns that I mentioned, 25% plus and so on, that comes with a fair degree of risk. When the stock market falls, you should expect your equity mutual funds also to at least mirror that performance. For example, if you take last year's example during the market crash, you will find that the Sensex itself fell by about 62% between January and March 09. The equity funds as a category fell by 65%. There were some stocks which fell by more than 90%. The worst performing stock that year in fact fell by 98%. That is, if you invested 100 rupees, you had just 2 rupees left at the end of the period. The worst performing mutual fund fell by about 80%. You would have been left with 20% of your original investment value. But during the recent recovery in the market, you will find that much of that money has been recouped.
Aarti, tell me also about how should I go about buying a mutual fund? Should I always go through an expert? Can I, if I consider myself, let's say, a more sophisticated investor, could I go directly and buy and sell these funds myself?
You sure can. Most funds, in fact, nowadays enable online investing, where if you go to the fund house's website, you will be able to buy and sell units as you please. In addition to that, if you're used to trading in the stock market through online platforms, many of the online platforms, say ICICI Direct, HDFC and so on, do allow you to transact in mutual funds too. So at the click of a mouse, you can easily buy or sell units at the time of your choice. However, if you're an uninformed investor, that is, you're not sure how to choose from the 250 odd schemes that you have, then you will need to take the advice of an expert in order to choose the right fund for your portfolio.
How does the mutual fund market compare to any other country? From a risk awareness point of view, from an investor education point of view, tell us a little bit about that.
I would say we are at a relatively nascent stage. Not many people are aware of the types of mutual funds that are available. Most people tend to associate mutual funds directly with the stock market, and they shy away from it for that reason. They liken it to gambling and so on. But actually people should understand that the diversification in a mutual fund, I mean spreading the portfolio out over many instruments, that helps a lot in containing the risk that is attributable to a mutual fund.
Aarti, how do I find out which mutual fund or which expert I could rely on?
Yes, I mean you do not have any government agency which will guarantee that your investment will perform well, because as I told you, that is linked to the market performance. But generally, mutual funds are very well regulated. In fact, if you compare all the financial instruments available to you in India today, next to bank deposits, which are basically come under the purview of RBI, mutual funds must be the most regulated financial instrument. SEBI, the Securities Market Regulator, is actually the regulator for mutual funds.
Thank you, Aarti, for those insights. Aarti and I will be back next week, same time, with more tips. But stay tuned. Right after the break, we bring you an exclusive interview with the Managing Director and the Chief Operating Officer of Titan Industries.